I'm Michael Brandwein, your favorite corporate attorney. I'm here to dish out all of your favorite mergers and acquisitions information. Before we get into it, make sure that you like, subscribe, and comment on this video. So what are earnouts? I'm going to tell you what they are, how they work, how they benefit the buyer, and how they benefit the seller. So an earnout is typically something that comes up in a purchase or sale deal where the seller wants the buyer to hit certain types of metrics, usually monetarily, in order to get paid part of the purchase price. So for instance, a seller is buying a shoe company, wants to pay $1 million for the shoe company, but says to the buyer, before I hand over all $1 million, I need to see over the next 3 years, call it, that this company is going to continue to hit certain metrics before I pay you out. And if it doesn't, I'm going to lower the sales price that I'm withholding from you. So the seller may pay $500,000 up front and say $500,000 is subject to this earnout. You as the buyer may get the other $500,000 spread over years, or you may get less based on certain performance metrics. That is an earnout. It usually favors the buyers, doesn't really favor the sellers. Well, it allows the buyer to protect their investment. They're buying, they're paying a lot of money. They're going to put up some of that money up front because the seller wants some of it, but they want to withhold a certain amount of it and see if this business is really worth what they want to pay for it. If so, great. If not, they're going to reduce the purchase price and how much they pay over a specific time period based on how the business is doing. So it's almost like an insurance policy. So if you're a seller and you're being forced to agree to an earnout, how can you protect yourself? There are some protective provisions that can be negotiated upon in the governing sales document. For instance, if you're subject to an earnout, you want to make sure that the buyer is actually paying you in accordance to what is agreed upon, and they're not messing around with the numbers. So you could request monthly financials, quarterly financials, annual financials, bank statements, other records to make sure that when the buyer comes to you and says, well, we don't think you're hitting your earnout provisions, we're going to lower the earnout for you, you could say, I want to make sure that that's correct and that you're not monkeying around the numbers and that you're not telling me that the business isn't doing as well as it actually is. Because of course, if the business isn't doing as well and there is an earnout, that favors the buyer because then they get to pay the seller less. So the sellers really need to protect themselves and make sure that they have the ability to inspect the records of the business that they are selling. With an earnout, there are different ways to structure an earnout. You may have heard of EBITDA, earnings before interest, taxes, depreciation, and amortization. This is a very common way to structure an earnout. You essentially look at the business and what the business is earning before interest, taxes, depreciation, amortization, and you think to yourself as the purchaser, where do I want this business to be a couple years down the line? That's what EBITDA is. That's how you can sort of calculate roughly where you think this business should go into the future after you acquire it, and how to structure an earnout. It's not the only way to do it, but it's one way to do it. Think of an earnout as trying to figure out where you want this business to go as far as the gross revenue, where you want it to be as far as the net revenue. These come together. Commonly, EBITDA is a way to say, I want the business to have these numbers next year, the year after, 3 years later, and I'm going to structure the earnout in every year after that. So EBITDA, very important, earnings before interest, taxes, depreciation, and amortization. I would say financial history is very important. Projections on where the business is going and where the industry is going. Another consideration too is, are you keeping on any of the key members from this business that you're acquiring to help you? Because that gives them a financial incentive to help you. They're getting paid, and that could certainly help you achieve your metrics, and then they get paid out in full, the purchase price subject to the earnout, and you have your business that's doing well, and they teach you how to run the business while this time period is happening. So think of it as performance metrics based on money, time, past history, and where you want to go in the future. Commonly, they're taxed as part of the sales price. So usually, if you're selling an entire business, and you've been holding your interest in the business, whether it's stock in a corporation or units in a limited liability company, you could get preferential long-term capital gains if you've been holding that interest for the requisite holding period. That's good for you. Now, the seller probably wants that because it's better taxation. The buyer would probably like to structure it as compensation for services so they can deduct those expenses in the current year like they would if they're paying an employee. So even the battle of how to structure it is something that's negotiated upon between the lawyers. But generally speaking, an earnout as part of the sales price, it usually favors the seller, not the buyer, because it's not a direct expense in the current year. It's usually part of the concept of, is this subject to capital gains or not, which helps the seller. Go to GordonLawLtd.com, like, subscribe, follow us. We have a lot of content. We can help you with your mergers and acquisition needs. I look forward to working with you.